you don't really need any additional indicator to look for it. So if you want a simple hack to identify these institutional candles, then follow this idea. So when you are looking at the chart for institutional candles, give extra attention to the body of the candles and not the wicks. The majority of the volume is held by the body, and big players are trading there. Wicks are not so much important as retail traders are trading there. Now you may ask me, why do these institutional candles form? The one word answer is obviously liquidity sweep. But for the sake of better understanding, let's just take the longer route. So whenever there is a buyer in the market, there must be a seller. So there must be somebody on the other side of the market to take the trade. This is true for all liquid markets and assets. And that is the reason why market prices moves, and this is where the institutional funding candle comes to play, as it acts as a fishing worm of the smart money to grab retail traders' liquidity. Generally, from a retailer point of view, the stop loss is placed above the swing high for a short trade position, and they will set their stop loss below the swing low for buy orders. Now, when institutions and big banks wants to sell, they will need more buyers. It's obvious, right? So what will they do? Keep in mind that these big players are looking to sell at higher prices, so they will require more buyers to buy from them at higher valuations. Most of the time, their modus operandi is the same. Initially, they breach the immediate swing high level with a big bullish candle with little or no wick. On different time frames, you might see different scenarios. You might see one big candle push in the 1 hour time frame, but on the 15-minute or 5-minute time frame on the same chart, you'll be able to see multiple candles push through above the highs. Remember that in the formation of institutional candles, the number of candles is not important. It may be one or more, but the crucial thing is the intention of these candles or the push, which is actually to take out the liquidity. Now, the stop losses of all the early sellers are triggered by this push, which is placed above the high. We know for a fact that the seller's stop losses are actually buyback orders. Besides this, the buy limit orders of breakout traders also exist above the high level. The institutional candles will also trigger these buyers' buy limit orders deliberately. This is the manipulation step. Further, the institutions will grab all the unwilling and willing buy orders as liquidity to sell their positions at higher valuations, and once the liquidity is absorbed, their intended bearish market movement will start. The same case happens during a bullish price move. So the intention of the big institutions is to buy at lower prices. So they will require a lot of sellers to sell at lower valuations, which will become their liquidity. And in order to create this liquidity, the big players will manipulate prices. The price will breach the immediate low or the support level with a big bearish candle with little or no wick. And as mentioned earlier, it can be multiple candles as well. It is not really the number of candles that matters, but it is the intention of these candles or the push. The stop losses of early buyers are triggered due to this price push, which were placed below the lows or the minor support. We know that the buyer stop losses are actually sell orders. Besides this, the willing sell orders of breakout traders also exist below the support level, which are also triggered in the process. And once the institution grabs all the unwilling and willing sell orders as liquidity, their intended upward movement will start. So the agenda of institutional funding candle is to take out or sweep the liquidity above or below the immediate resistance or support lines respectively. Now you can ask me, why do these institutional candles actually work in the market? Now the strong reason why institutional funding candles work in the market is because these are the drawdown or loss of the smart money. I know you are confused, but let me explain. If the big institution wants to buy at lower valuation, they will need more sellers who would sell at lower prices. For generating enough liquidity, they will manipulate the prices. In this case, they will create a single bearish candle or a group of candles below the immediate low or the support level. This means the institutions are actually selling here, but their real intention is to buy. But they sell initially to trap the retail traders in their trades so that they can start using the retail orders to buy at lower prices. And when the price returns back to the previous support level, they would exit their short positions on a break even or on a small loss. And as you can guess, these institutions won't take such unnecessary positions and losses unless they want to make a much bigger gain. So keep in mind that usually when the price comes back to the manipulation zone, smart money would close their counter order with a small loss or break even. As they mitigate their position, these are the best places to take a trade and make some profits by following the footprints of the smart money. Now let us discuss what makes institutional candles important. Institutional candle helps you to determine order flow and market structure. Yes, you heard it right. We know what an order flow is. So a bullish order flow is the last selling move before a buy on a bullish market structure, and a bearish order flow is the last buying move before a sell in case of a bearish trend. Now look at how institutional candles form. It follows the AMD criteria. This means the manipulation move, which is the IFC, will act as the order flow since it is the price move against the major trend structure. Now IFC can also be used to determine market structures. This is because institutional candles usually form the extreme highs and lows in a price move before the actual distribution in prices. These highs and lows can act as swing highs and swing lows, which are reference points for mapping the market structure. In addition to this, IFC is also a popular trade entry strategy. You can think of trade setups in the dominant trend direction, and the trade entry orders can be placed after the last price push up or push down beyond the zone, which is an important strategy that many traders follow. Actually, institutional candles forms swing highs or swing lows, so there are high chances that the market will never violate or break beneath the low of the last down close candles in a bullish market, and likewise, price will never violate and break above the last up close candles during a bearish trend. In addition to this, if you have watched my videos on liquidity, that is both major and minor liquidity, and if you have done analysis on the charts, then you might have come across innumerable situations of liquidity manipulations taking place in different locations and in different scenarios. These liquidity manipulations could be near equal highs and equal lows, near supports and resistances, during consolidation breakouts, trendline breakouts, during pattern formations, and so on. And on most cases, within these manipulations, you can spot institutional funding candles, which goes deeper to grab the retailer orders. So what I mean to say is that IFC is a very common manipulation type that you can find on the charts. Now let us learn in detail as to how to trade with these institutional funding candles. So first of all, you will have to mark up your major swing points that are formed by the institutional funding candles. Remember that in the upward moving market, the last down close candles are usually respected, while the last up close candles are respected in the bearish trending markets. In case if the market is in a consolidation period, then both these types of institutional candles are respected. Once you have identified the IFC candles, you need to mark the IFC range. For this, you need to select the Fibonacci tool from the toolbar and then select the highest and lowest points in the institutional candles. So the idea is to start plotting the Fibonacci retracement from the origin of the IFC candles. For bearish candles, start drawing from the highest to lowest point, and for bullish institutional candles, begin from the lowest point and follow through to the highest point. The Fibonacci retracement levels will be automatically plotted, but we only require the 0%, 50% and 100% levels. You can go to the Fib settings and change it accordingly. Now, even though you can execute a trade anywhere within the range of the institutional candles, it is mostly preferred to enter a trade either near the opening price of the institutional candles or at the 50% of the push. So you can trade within the Fib 100% to Fib 50% levels. This is your tradable zone. Now, where to take a trade entry is entirely up to you, depending on whether you are aggressive or conservative in your approach. But let me tell you, if you plan to take trades at 50% of the institutional candles, then you might miss some of your entries because price never always returns to the 50% level. But on the upside, if your limit order or market order is executed at 50% level, then you will definitely get a better reward to risk ratio. One additional thing you can do is you can use the Fibonacci retracement tool once again and select the Fib 1 and Fib 0.5 levels. This will generate another Fibonacci level at the 50% of our entry zone. This can further improve our chances of getting into most of the trade opportunities without having to take much risks. When it comes to stop loss setting, your stop loss should be placed above the highs of the institutional candles for the sell orders, and it should be placed below the low of the down closed institutional candles for buy orders. You can even place your stop loss above or below the institutional candle's body or wick. But I personally prefer to place my stop loss above or below the wick. This is the best and safest place to place your stop loss. Now let's talk about the targets. Your take profits should be placed at the next area of interest or price of interest. It could be the next higher low, support or resistance, supply or demand zone, equal highs or equal lows, where ample liquidity exists to drive the market to the opposite direction. You can also place your take profits by analyzing the higher time frames. I think that as a beginner to SMC concepts, a bigger win rate is more important than the large reward to risk ratio. So you should cut over expectations and place your targets at a specific logical area and be consistent with it. And always try to improve your entries, thereby you can maximize your rewards. Now let's take an example to understand the concepts even better. In this case, the price is trading within a range. In such cases, both the up closed and down closed institutional candles are usually respected by prices. Now as you can see, price formed equal lows which I have marked here, and then it consolidated for a while. Then the price moved lower and it broke below the equal lows with candles having deep wicks to sweep the liquidity below this level. And once the liquidity was absorbed, the price moved swiftly, creating imbalances or fair value gaps on the way up. These imbalance formations are very important. It gives a reason for the price to return back and fill the inefficiency that was created. To know more about fair value gaps or imbalances, you can watch my video on the same topic. Anyways, when the price starts to move higher, we can identify the manipulation candles. In this scenario, these are the last down close candles. I have marked these candles. Now I have to identify the tradable IFC range. For this, bring up the Fibonacci retracement tool and select the highest point in the IFC candles, and then drag the cursor and select the lowest point in the institutional candles. This will give you the IFC range. As I have mentioned before, when price returns back to this range after mitigating the imbalance, we will look for long trading opportunities from Fib 1 or Fib 0.5 levels. If you want, you can also draw another Fibonacci retracement between the Fib 1 and Fib 0.5 levels to obtain another 50% level at the midpoint of these two levels, which will give a higher probability that your buy limit orders will get executed, and this intermediate level will provide a better risk to reward than the Fib 100% level. Now let us observe what the market did. The market moved higher, broke above the consolidation, after which it reversed, took a short reaction, and once again break below the resistance turn support level. Further, price consolidated near the resistance area where it formed equal highs. I have marked this level. Now the price made a build up and eventually break above the equal high level to sweep the liquidity above it. After the liquidity hunt, price returned lower. This manipulation was in form of a level breakout following a consolidation. After the manipulation, price declined lower swiftly, creating an imbalance or a fair value gap. This is a classic case of AMD or power of 3 concept. Also, this imbalance or inefficiency is a crucial part of the overall concept because it gives price a strong reason to return back and fill the inefficiency in prices. The manipulation move or the liquidity grab was done by institutional candles. In this case, the last up close candles are our IFC candles. I have marked these institutional candles here. Now we have to mark the tradable IFC range using Fibonacci tool. For this, bring up the Fibonacci retracement tool and first select the lowest point of the IFC candles and then select the highest point of the institutional candles. Our tradable zone is between Fib 1 and Fib 0.5 levels. You can also mark the intermediate level between Fib 1 and Fib 0.5 levels for getting good results. So the overall idea is to place sell limit orders at any of the mentioned Fibonacci levels when the price returns to fill the inefficiency, and there are very high chances that the price will tap into this Fibonacci range and our sell orders will get executed. Now let's see how the trade has turned out in both the cases. So the price returned to our bullish trade setup. all the buy limit orders between Fib 1 and Fib 0.5 levels are executed. You can set your stop loss below the low of the IFC range. For target placement, you can choose this recent swing low level as your first take profit level. You can also choose the resistance level for target, but the probability of price reaching this level is low. And as you can see, the price moved higher and attained our first target. But the price did not move all the way up. Instead, the price reversed once again and sharply moved lower. Once an IFC range is tested, it is not useful anymore. The price breaks through all these ranges. Keep in mind that our bearish trade setup is still active, and after a while, price reversed sharply and it started to rise again. It came back to fill the price inefficiency and it tested all the sell limit orders placed between Fib 1 and Fib 0.5 levels. In this case, our stop loss can be placed above the high of the IFC candle. Our target can be set as the previous low formed, and as you can see, the price moved lower and hit our take profit level. I hope things are clear now. So you have to identify equal lows, equal highs, support resistance levels where possible manipulations may occur and the institutional candles might form. Then you have to mark up the candles. It might be one candle in the higher time frame and multiple candles in the lower time frame. Now you know how to spot this smart money manipulation. Institutional candle is an advanced price action trading concept also. So make sure you learn this concept properly, backtest this strategy in multiple charts, and improvise consistently in paper trading. And when you get positive results, then only you should implement it in your live trading. In this episode, we will learn an advanced tutorial on a rather interesting smart money concept, which is regarding the identification and utilization of flip patterns and flip zones. So in this video, I will talk about flip zones, the different types of flip entry models, and I will also give you the important rules to identify and mark valid flip zones. These are powerful concepts in smart money strategies, and neglecting them in your trading may leave you lagging behind the changing market trends. So by understanding and utilizing these essential techniques, you will gain the adequate expertise to identify high probability flip setups, and you will also be able to make well-informed trading decisions. So if these series of videos are useful for you, then give this video a thumbs up to show your support, and make sure to subscribe to our channel and also enable the bell notification to get all the latest updates. So without wasting any time, let's get started. As the name suggests, the term flip in the flip pattern indicates a market transition from one direction to the other, thereby implying a change in the market sentiment. This could be a shift from bullish to bearish or vice versa. Flips are often viewed as crucial turning points or areas where the traders have potential opportunities to capitalize on the changing market dynamics. The flip trading entries are considered as an effective method to enter quickly during market declines or surges. So, how can you define a flip pattern? You can think of a flip pattern as a particular price pattern or configuration on the price chart that indicates a potential shift or flip in the market direction. Flips signal a transition from an existing trend to a possible reversal, or it indicates a shift in the market sentiment. So the overall idea of a flip pattern is simple. A flip pattern involves reacting to a significant price zone in the chart and then effectively breaking through it. These significant price zones could be support or demand areas, order blocks, gaps, important highs or lows, etc. Now, the flip patterns are majorly divided into two main categories. These are reversal flip patterns and continuation flip patterns. We will talk in detail about each one of them. First, let us look at how we can spot a reversal flip pattern. Let's imagine a bullish market structure with a consistent formation of higher highs and higher lows in prices. To identify a valid flip pattern, we have to consider a few key criteria. First of all, the price should face a rejection from a higher time frame supply zone. So when you mark the structure on higher time frames like 1 day or 1 hour or any higher time frame based on your trading style, you will be able to identify such price zones where we can expect the price to face some resistance. These could be major resistance areas, unmitigated higher time frame bearish order blocks, price gaps, daily, weekly or monthly highs, etc. All these levels or zones can act as a supply zone and reject the prices. Now, after encountering a resistance at the supply zone and declining, the price should retest the last formed demand zone and then move upwards, showing a rejection from this demand zone. But the crucial thing to make sure is that the price should not establish a new higher high, but instead, the price should break through the previously tested demand zone. This break of the demand zone forms a new supply zone, which is referred to as a flip zone. This flip zone is marked on the basis of an imbalance formed while breaking through the demand zone. We will talk about how to mark a flip zone in a short while. It is vital that we closely monitor this newly formed flip zone, since the likelihood of price returning back to retest this zone is very high. It is usually recommended to place a sell limit order within this supply flip zone to enter into a short trade position when the price retests the flip zone. The same principles apply in a bearish scenario. In case if the market is consistently making lower highs and lower lows, thereby indicating a bearish market trend, then we will wait for price to find a support on a higher time frame demand zone and then move higher. This demand zone could be an unmitigated higher time frame bullish order block, a major support level, price gaps, daily or weekly or monthly lows, etc. As the price decline lower, it should react with the last formed supply zone on the same time frame that we are analyzing and then move lower. But the crucial part is to make sure that this price reaction should not establish a new lower low, or it should not form a bearish break of structure, but instead the price should break through the previously tested supply zone. This break of the supply zone will form a new demand zone, which is called our flip zone. Marking the flip zone is based on price imbalance formed during the supply zone break. We should closely monitor this flip zone because there are high chances that the price could return back to retest this zone. It is a usual practice to place a buy limit order within this demand flip zone so as to enter into a long trade position when the price retests the flip zone. Here, I would like to highlight a key point. A flip pattern wouldn't exist without a reaction from the last demand or supply zone. At least some of you might look at this and ask me, isn't this a change of character? Although the flip pattern shares similarity with change of character pattern, not every change of character is a flip, but on the opposite, every flip is a change of character. Actually, a flip is a specific type of change in the market dynamics where the price reverses and establishes a new structure. This pattern, as I have already mentioned, is characterized by a clear rejection from the last supply or demand zone, followed by a subsequent break of that price zone, creating a flip zone. Setting up trades for the flip pattern is similar to those setups that we have for a change of character pattern, thereby allowing the use of both aggressive and conservative entry types with the flip zones. We will not delve deep into each of these entry types in this video. We will talk about all the entry types and risk management strategies in the next season of Smart Money Concepts. But now, let's briefly analyze the flip pattern through a detailed candlestick analysis and come up with some rules to identify the best reversal flip patterns. It is observed that the flip pattern's effectiveness is greatly enhanced when the price reacts aggressively and push away from the demand or supply zone and then swiftly breaking through either the last demand zone or the last supply zone, thereby leaving behind an inefficiency. We have already made a video about inefficiencies or imbalances or fair value gaps in this course. You can check it out if you want to know more. If you have spotted an imbalance or inefficiency in price while breaking the supply or demand zone, then all you have to do is to find the extreme candle formed during the price pullback from the supply or demand zone before the price break through the supply or demand zone. You can mark the highs and lows of this candle using a rectangle, and this will be our flip zone. It is even better if this extreme candle is followed by a large bodied imbalance candle. But just keep in mind that the breakout move should be associated with a price imbalance. We will understand the reason for this in a short while. Now, it is crucial to recognize the fact that the strength of demand or a demand zone can be assessed by the level of rejection that it provides to prices and its ability to drive price to new higher highs. If the demand associated with the zone is weak and it fails to generate substantial momentum and eventually leading to a break through the zone, then it signals a shift in control towards the new supply zone, or we can say that the bears are gaining dominance. So as SMC traders, we can concentrate on trading the supply side of market in these situations. On a similar note, the strength of a supply zone can be gauged by the level of rejection it provides in pushing the prices to form new lower lows. If supply turns out to be weak and it fails to produce substantial price momentum and thereby eventually leading to a break through the zone, then it signals a shift in control towards a new demand zone, which indicates that the bulls are gaining traction. So as an SMC trader, you can focus on trading the demand side of market, that is, look for long trading setups. Now, let's outline some rules and other criteria for identifying valid and high quality flip patterns and zones in the market. I will discuss 4 essential rules that you can follow in order to identify valid flip patterns and zones with a high probability of success. The first rule states that for a reversal flip pattern to be considered valid, the price must first mitigate and reverse from a higher timeframe supply or demand zone. This rejection from the higher timeframe supply or demand zone indicates the possibility of a change in the market sentiment, thereby setting the stage for a potential flip to occur. In other words, the price should react from a significant supply or demand level before forming the flip pattern. So if the price fails to mitigate a higher timeframe supply or demand zone and then simply forms a flip pattern, it cannot be considered a valid flip pattern. Now let's talk about rule number 2. This rule states that for a valid flip pattern to occur, the price must react from a supply or demand zone, create a pullback, and then break through the supply or demand zone. Without a pullback or any rejection of price from the supply or demand zone, the pattern cannot be considered as a valid flip pattern. Moving on to rule number 3, this is a very important criteria that needs to be satisfied. It states that a high quality flip pattern should create a significant imbalance or inefficiency when flipping a demand or supply zone. This imbalance or inefficiency should be associated with a clear change of character, or in other words, it should involve a swift, powerful price movement that invalidates the previous market sentiment. Let us understand the reasons why this is very important. Imbalance represents an inefficiency between buyers and sellers, leading to a disequilibrium in prices that needs to be filled. Often imbalances are seen as a gap within the candles. These are also known as fair value gaps. To understand this better, we will consider 2 scenarios. If a 3-candle sequence, as shown here, lacks gaps between the high of the first candle and low of the third candle in case of a bullish scenario, and if a 3-candle sequence lacks a gap between the low of the first candle and high of the third candle in case of a bearish scenario, then these are examples of efficiency in the market. This means the price action is balanced and there is no imbalance or inefficiency that needs to be filled. Conversely, the presence of a gap within the first and the third candle, as shown in these scenarios, signifies an inefficiency or imbalance in prices that need to be filled in order to balance the price action or to make the market efficient. Therefore, the presence of an imbalance during the supply or demand zone break will increase the probability of the price returning back to fill this inefficiency, which will in turn improve the chances of our flip zone being tested. I hope things are making sense. Now the last rule, that is rule number 4, emphasizes that a valid and high probability flip zone must be unmitigated. It means price should not test our flip zones when moving to break through the supply or demand zones. Flip zones are considered as one-time use thing, just like order flow or order block areas. We will focus on only those trading opportunities when the price first enters a flip zone. Once a flip zone has been mitigated, meaning the price has moved beyond its boundaries, and the inefficiency associated with it has been filled, it will lose its significance as a trading area, and we will not consider it as an area or price of interest for our future trades. And subsequent retests of flip zone may not offer the same trading opportunities as the initial trade entry. Now, we can use aggressive or conservative entries when trading with the flip setup. As I have mentioned before, we will cover different SMC entries and risk management strategies in the second season of this SMC course. But to give you a general idea, while trading the reversal flip setups, take a short trade from or within the supply flip zone and take a long trade from or within a demand flip zone, and price pulls back to fill the inefficiency formed during the breakout. Now that we have extensively discussed the reversal flip pattern, let's explore the specifics of the second flip pattern type, which is the continuation flip pattern. The continuation flip pattern can be divided into 2 types. It can be either a supply to demand flip pattern or a demand to supply flip pattern. Let's begin with the supply to demand flip pattern. The supply to demand flip pattern is a type of continuation flip pattern that involves a price transition from a supply zone to a demand zone. As the name suggests, it implies a shift from a supply zone to a demand zone. This flip pattern indicates a decrease in the selling pressure and an increase in the buyer control or dominance, thereby suggesting a potential continuation of the bullish trend. Traders spotting this pattern can seek opportunities to enter long trade positions as the price reverses from the supply zone and move towards a demand zone. Now let's look into this scenario in greater detail. For this, let us consider a bullish market where the price has mitigated the extreme demand zone or the extreme bullish order block and begin to reverse, thereby continuing its upward movement towards the next unmitigated higher time frame supply zone. However, in this scenario, an interesting twist unfolds. Instead of respecting this unmitigated supply zone and reversing lower, the price sharply surges upwards, breaking through the supply zone. So this break of the supply zone indicates a lack of bearish momentum to sustain the selling pressure. It also implies that the bulls have taken control, thereby suggesting a potential continuation of the existing bullish trend. This scenario creates a perfect demand zone that is generated by the price wave that flipped the supply zone. So the new demand flip zone can be marked as the extreme candle in the price wave that caused the break above the unmitigated supply zone. Also keep in mind that here also the price needs to form an imbalance or inefficiency during the breakout wave. Typically, after such a flip pattern formation, the price may return to this flip zone to mitigate it and then resume its upward movement. The reason why price returns to this flip zone is due to the imbalance created by prices during the inefficient breakout move. This is what we call a supply to demand flip pattern. It signals a shift in market dynamics from selling pressure to buying pressure, presenting a potential opportunity for traders to consider entering into long trade positions, thereby anticipating the continuation of the bullish trend. Similar concepts apply to demand to supply flip pattern as well. Let's talk about it now. In this pattern, the price shift from a demand zone to a supply zone, suggesting a decrease in buying pressure and an increase in the selling interest, thereby indicating a potential continuation of the prevailing bearish trend. In this scenario, we have a bearish market where the price enters the extreme supply zone and starts to reverse, continuing its downward movement towards the next unmitigated higher time frame demand zone. However, something interesting occurs in this situation. Instead of respecting this unmitigated demand zone and reversing higher, the price sharply pushes downwards and breaks through the demand zone. This break of the demand zone indicates a lack of the bullish momentum in the market, thereby signaling a shift in control from buyers to sellers. This creates a perfect supply zone that is generated by the price wave that flipped the demand zone to the downside. So the new supply flip zone can be marked as the extreme candle in the price wave that caused the break below the unmitigated demand zone. In this case also, price needs to form an imbalance or inefficiency during the breakout price move. Typically, after such a flip pattern occurs, the price may retrace back to our flip zone to fill the inefficiency and thereby even mitigate the supply flip zone before resuming its bearish movement. So this is what we refer to as a demand to supply flip pattern. It denotes a shift in the market dynamics, suggesting a potential opportunity for traders to consider entering short positions, anticipating the continuation of the prevailing downtrend. Now, let us look at an example. Here, we have a 1-hour time frame chart. The price has formed a series of bearish breakout structures, indicating a bearish trend. We can also notice an unmitigated demand zone in the 4-hour time frame. Upon reaching this higher time frame demand zone, many traders would expect a potential reversal and they would start looking for signs of a change of character to enter into long trade positions. But contrary to their expectations, price taps into the 4-hour demand zone, experiences a minor pullback, and it crashes downward with significant momentum. This aggressive price move is associated with inefficiencies or imbalances that needs to be filled to regain the balanced price action. This movement causes a flip in the demand zone, indicating a shift in the market dynamics and potentially signaling a continuation of the bearish trend. We can mark this newly formed supply flip zone at the extreme candle of the inefficient price wave that caused the break of the higher time frame demand zone to the downside. The break of the demand zone also signals a lack of bullish momentum, indicating a shift in control from buyers to the sellers. And as you can see on the chart, the price retraces back to the supply flip zone, experiences a reaction, and then aggressively move downwards with significant momentum. Traders can look to take short trades from within the supply flip zone formed. So this is all you need to know about supply and demand flips. In this video, we are going to learn about two important reference areas or zones in SMC. I will talk about breaker blocks, mitigation blocks, and how you can use these concepts to improve your chart analysis. I will explain what these are, the psychology behind them, and why they work in the market. We will also learn how to identify and trade them. So traders, if these series of videos are useful to you, please hit the like button to show your support and subscribe if you're new to this channel. So without wasting any time, let's get started. Breaker blocks and mitigation blocks are reference areas on charts where you can potentially find a trade opportunity. Breaker block and mitigation block concepts are almost the same, but their formation pattern is different. The general definition of a breaker block and mitigation block are similar. The general definition states that a breaker block or even a mitigation block is a failed order block that turns into another supply or demand area on the chart. From my basic price action course, we know that whenever the price breaks through a resistance level, it becomes a support due to the behavior of market participants. Similarly, whenever the price breaks through a support level, it starts to behave like a resistance when the market taps into that area again. This is the simple principle of polarity. The same concept applies to breaker and mitigation blocks as well. The market could ignore an order block's supply and demand for many reasons. These could include a shift in the market structure, price being overvalued or undervalued, price tapping into higher time frame key levels or prices of interest, and there can be many more such reasons. Now, when a valid demand level fails to reject the price, and if the price breaks through, it becomes a supply level. The overall logic is correct, but involving order blocks into the mix is what I cannot digest. Considering mitigation blocks and breaker blocks as failed order blocks doesn't always make sense. If you have watched my video on order flow and order blocks, you might have noticed the number of criteria that needs to be satisfied in order to identify a valid order block, be it a valid market structure break, an inducement, a proper liquidity sweep, presence of an unmitigated imbalance, etc. You might have also realized that order blocks are not always found at the extreme swing points. We might have to shift our order blocks for obvious reasons. Now look at these two figures where I have marked a breaker block and a mitigation block. One thing that catches the eye is that both these figures are associated with a change in the market structure or simply a change of character. Another important observation is that both these blocks are formed at the extreme points of the price swing. So calling it a failed order block doesn't actually do justice for order blocks because order blocks don't always get formed at the extreme swing points. This is why I don't want to involve order blocks when it comes to breaker blocks and mitigation blocks. There is one other obvious reason which will strengthen my analysis. Comment down below if you have spotted it. I will reveal it when we talk about the mitigation blocks. Having said that, what is a proper way to define breaker blocks and mitigation blocks? This idea is simple to grasp if you associate it with basic price action. In the smart money trading concept, it is called a breaker block and a mitigation block. And in the price action concept, it is called a breakout and retest. The idea behind a breakout and retest, or breaker block or mitigation block, is that if the market can successfully retest the breakout level and continue in the same direction of the breakout, it confirms the breakout's validity and suggests that the market will likely continue moving in the direction of the breakout. In SMC terms, there is liquidity on offer above the extreme swing highs and below the swing low levels. So here in search of liquidity, the market can break through the extreme swing low level, forming a bearish change in the market structure. This further brings in a lot of sellers who would start shorting the market while placing the stop losses above the extreme swing low level or the support. So the market will likely return back to sweep these stop losses and limit orders which are accumulated above the support. So this is actually the reason why breaker blocks and mitigation blocks work in the market. Let's learn how to identify a breaker block. A breaker block involves looking for key support or resistance levels on a price chart that may cause a significant change in the price direction when the level is broken. So when a support resistance or supply demand level is breached, it is considered as a significant signal that the price may continue to move in the breakout direction. Once the breakout is established, we have to wait for the price to return to the breakout level to confirm that it has become a new support or resistance level. And once the level has been confirmed, traders can enter a trade in the direction of the breakout. So a breaker block can be an area of supply or demand which was broken through by prices, leading to a change in the structure, and it is only confirmed after price retest back to the breaker block. It should be noted that the polarity of the breaker block changes after the breakout. That is, if it was a supply zone, it would become a demand zone after breakout and vice versa. This is the whole idea behind identifying and trading breaker blocks. But let's dive deeper into the entire process. We will begin our discussion with a bearish breaker block. For identifying a bearish breaker block, first we need to identify a swing high and a swing low in prices. Then, the market should break above the high to form a new higher high. We don't have strict rules here, like the price should break and close above the previous high and it should take out an inducement. Nothing like that is required here. Even if all these conditions are met, then also it is fine. In this case, the price has to just break above the previous high to create a higher high point. This could even be the wick of a candle. It should just sweep the liquidity available above the previous high. But if this move is associated with an inefficiency, then it would be even better. This would mean that more participants would expect the price to come back lower to fill the imbalance, and these players will look to go long from these discounted valuations. Once the higher high is formed, the price should move lower and break below the previous low to create a lower low. But here, it is recommended that we should wait for the price to actually break and close below the previous low. So essentially, there is a break of a high and a low. Once the lower low is confirmed, we can identify a breaker block. For this scenario, the last down close candle or the deepest or lowest candle in the group of the last consecutive down close candle will be our bearish breaker block. In case if there are 3 or 4 consecutive down close candles, you have two options. One is to mark the whole area from the highest to lowest point, including the wicks. The second option is to mark only the highs and lows of the last down close candle or the lowest candle in the mix. I would recommend using the second method because in the first scenario, the risk associated with it and the stop loss placement would be higher. It is vital to involve the lowest candle in the swing low, and it doesn't matter what the color of the candle is. Now, this block used to be a demand zone, but now it has been converted to a supply zone. Unlike the case of an order block, we don't have to see if there is an imbalance and a liquidity sweep, and unlike an order flow, we don't need to check if it is unmitigated. For a bearish breaker block, we just need to find the last down close candle or the lowest candle in the series of consecutive down candles and mark them from wick to wick. Once the breaker block is identified and marked, we expect the price to return back to this breaker block and then continue to decline lower. The breaker block is validated when the price returns to retest it. But here, I would like to add an additional condition to make this setup a high probability one. The condition is simple. When the price breaks through the breaker block, it should be associated with an imbalance or a fair value gap. Specifically, a SIBI, that is a sell side imbalance and a buy side inefficiency. If a sell side imbalance is generated during the breakout below the breaker block, this will become a high probability setup because it gives price more reason to retest our breaker block as the price imbalance need to be filled in order to make the market efficient again. This setup is known as the unicorn setup. Let us briefly understand the logic behind the whole concept. The market forms a new higher high, but contrary to forming a higher low, the market breaks below the previous low and makes a change of character instead. As a result of the aggressive move breaking below the previous low, the directional bias has changed to bearish and our demand level will turn into a supply level after this break has occurred. The psychology behind the breaker blocks is that the traders who got long from the demand areas are now trapped after the bearish market structure shift. So they would want to wait for the price to get back to their break-even spot where they can close their long positions for little to no losses. Also, traders will start taking short trades here since they see this area as a key area of supply. The outcome of this double action is what makes the price reverse from this area. So one of the key points here is that a breaker blocks forms when we have a run of liquidity before a market structure shift. Keep in mind that this breaker block concept is applicable to the internal market structures also. We can take trades from breaker blocks when they are formed within the minor structure. Breaker blocks are one of the 7 institutional reference points in SMC, which is very important when using the PD arrays. We will talk about PD arrays in the penultimate episode of this season. Anyways, when price returns back to the bearish breaker blocks and move lower, we can look to enter into short trades. Now, another thing you can do is to draw a Fibonacci retracement connecting the highest and lowest points on the breaker block. We only need the 0%, 50% and 100% Fibonacci levels. You can adjust this in the settings. This way, we can optimize your trade entries. You can look to place sell limit orders or take short trades between the Fib 0.5 and Fib 0 levels. You can set your stop loss above the breaker block or above the Fib 1 level. You can set your targets based on the previous market swings, or you can even use the price projection method for setting the take profits. We will talk about breaker block trading strategies in the second season of the SMC course. Anyways, let's now learn about bullish breaker blocks. Here also, we need to identify a swing high and a swing low. The price should take out this low and form a new lower low. This is a liquidity sweep below the previous low. It is better if this particular move is associated with an inefficiency. Once the lower low is established, we want the price to swiftly move higher and break and close above the previous high, thereby forming a new higher high. When the price breaks out above the previous high, we can mark the last up close candle or the highest up close candle or the group of consecutive up close candles in the swing high. This becomes our bullish breaker block, which acted as a supply zone before, but now it is converted to a demand zone after the structure change. As mentioned before, it is ideal to mark only the last up close candle or the highest up close candle when dealing with a group of candles when drawing the breaker block. The color of the candle doesn't really matter. This will help us with better risk management. Now, if the breakout move is associated with a fair value gap or an imbalance, specifically a BISI, that is a buy side imbalance and a sell side inefficiency, this gives price a reason to return back to fill the imbalance and thereby test our breaker block. Then this becomes a high probability trade setup known as a unicorn setup. Now, when the price returns back to our bullish breaker block, we can plan to take long trade positions. We can use a Fibonacci retracement tool to mark the Fib 0, Fib 0.5 and Fib 1 levels by connecting the lowest and highest points in the bullish breaker block. This will help you optimize your trade entries. You can place buy limit orders between Fib 0 and Fib 0.5 levels. You can set your stop loss below the breaker block or below the Fib 1 level. You can set your targets based on the previous market swings, or you can even use the price projection technique for setting take profits. So some of the key factors that you need to consider while trading breaker blocks are: number 1, market structure. You need to identify the current market structure before looking for breaker blocks. Market structure includes defining the market direction, supply and demand areas, higher time frame key levels, liquidity areas, etc. Number 2 is validity. Make sure the breaker block you identified is valid. Breaker blocks are created by a run of liquidity before the market structure shift. So you need to look for sharp moves with fair value gaps between the wicks that creates inefficiency. And finally, number 3 is confirmation. Wait for confirmation before entering a trade. Confirmation can be in form of many price action signals, candlestick signals, volumes, etc. Now, let's quickly dive into mitigation blocks. We will begin with a bullish mitigation block. So first, we need to look for a swing high and a swing low. Then mark these points. Now the prices moves down but it fails to break below the low. It is unable to take out the liquidity below the low. The price moves higher swiftly, breaking through the high and closing above the high, resulting in a market structure shift. Once the breakout above the high is established, we can mark the last up close candle or the highest candle in the series of up close candles forming the previous swing high. This will be our bullish mitigation block. It is ideal to mark the highs and lows of the last up close candle or the highest candle in the mix as the bullish mitigation block when there are multiple consecutive candles, as it provides better reward to risk for the trades. Now the color of the candle doesn't really matter much. In addition to this, if the breakout move is associated with an imbalance or a fair value gap, more specifically a BISI, that is a buy side imbalance and a sell side inefficiency, then this will become a high probability setup for our trades. This inefficiency will be a motive for prices to return back to fill the imbalance and thereby even testing our bullish mitigation block. We can look for long trades from this mitigation block. You can also optimize your entries using Fibonacci levels. For this, extend a Fibonacci retracement from the lowest to highest points of the mitigation block. We only require the 0%, 50% and 100% levels. So the idea is to place buy limit orders between Fib 0 and Fib 0.5 levels. You can set your stop loss below the mitigation block or below the Fib 1 level. As you can see, the only difference between a bullish breaker block and a bullish mitigation block is that the breaker block is associated with a liquidity sweep below the lows, thereby forming a lower low. But in case of mitigation blocks, price fails to execute a liquidity run below the previous low, thereby failing to create a lower low. This is the reason why mitigation blocks are also known as swing failure patterns or swing failure blocks. This also proves another important point. Since the price was unable to break the previous low, this means the use of order blocks as mitigation blocks cannot be justified. Think about it. The first condition that needs to be satisfied if we are to identify order blocks is that the market needs to form a valid breakup structure. But here, the price didn't even sweep the previous low. So the concept of order blocks being used as supply or demand area is significant in this case. This is why I refuse to accept the idea of mitigation blocks and breaker blocks being considered as failed order blocks. I hope you get the essence of it. Now keep in mind that just like a breaker block, the mitigation block is also one of the 7 institutional reference points in SMC. Mitigation block trading is also applicable in minor structure. Mitigation blocks can be used to take trade positions from the internal market structure when formed within a PD array. Now let's quickly touch upon a bearish mitigation block. As always, identify the swing high and swing low in prices. In this case, price fails to sweep the liquidity above the high and it swiftly declines down, breaking and closing below the previous low. So the price was unable to establish a new higher high. So this is a swing failure. Once the breakdown below the low is confirmed, we can mark the last down close candle or the lowest or deepest candle in the mix, including the VIX, and this will be our bearish mitigation block. If there is a price imbalance or a CB associated with the breakdown move, then the probability of price returning back to our mitigation block increases because the price will try to fill the inefficiency. For trade entries, use Fib 0 and Fib 0.5 levels to place sell limit orders. You can set the stop loss above the mitigation block or even above the Fib 1 level. Now being a swing failure pattern, I'm not particularly interested in trading from these mitigation blocks because liquidity is still available beneath these swings, due to which the market could just reverse, thereby hitting our stop losses and taking us out of the trade. So be a little cautious while dealing with mitigation blocks. In this video, we will learn about rejection blocks. Rejection block is a sophisticated concept in SMC methodology that is essential for identifying potential reversal points in the market. This is another important reference point in smart money concepts. So in this episode, we will discuss what rejection blocks are, how to identify and mark these blocks, and we will briefly talk about how to trade these blocks. If you find this series of videos useful, please like the video to show your valuable support, and don't forget to subscribe to our channel because good things are yet to come. Now, let's begin our discussion on rejection blocks. A rejection block can either be a sell zone or a buy zone that appears on the chart as long wicks or shadows of candles at the market highs or lows. This block is characterized by a specific candle or a series of candles with long wicks, indicating the strong rejection of a price level or a price zone, typically occurring at key support or resistance zones or near important supply or demand zones. This signifies that the market attempted to break through a price level, but the effort was promptly rejected, thereby hinting at a strong underlying market sentiment contrary to the attempted price move. Such patterns indicate a significant struggle between buyers and sellers, leading to a rejection of the prevailing price trend. This pattern is perceived as a clear indication that the market is not ready to sustain prices beyond that level, be it due to extreme opposition or other institutional factors. So, SMC traders keenly look for rejection blocks as they often precede significant trend reversals or retracements, making them invaluable price areas for predicting future market movements, and also helps in strategizing entry and exit points when it comes to trading from these blocks. Now, let us learn to identify these zones. So, what are the things to look out for? A rejection block is identified on a price chart as a specific pattern where the market strongly rejects a certain price level or zone, indicating a potential shift in the trend. So, the first point is to identify key areas of interest where the price has a good chance of giving a reversal or a retracement after a rejection. These areas can be support or resistance zones, supply or demand zones, or important highs or lows like the daily or weekly highs and lows, etc. The other point to note is that a rejection block is often represented by one or more candlesticks that show a sudden and decisive move towards an area of interest, only to be followed by an equally sharp reversal. This means that a rejection block is formed only after capturing the liquidity from the previous high or low, or equal highs or equal lows. So in price action, this is called a false breakout, and in smart money terms, this is called a liquidity sweep. Now that we know what to look for in the charts, let us learn to mark rejection blocks in the correct manner. Rejection blocks are classified into two types: a bearish rejection block and a bullish rejection block. The logic for constructing a rejection block is very simple. Let's start with a bearish rejection block. A bearish rejection block occurs when the price spikes up but then falls rapidly, indicating a rejection of higher prices, thereby signaling a potential downward movement. So effectively, we are looking for a swing high, that is, we have to find the highest candle. The high and close price of this candle has to be higher than the high and close of the neighboring candles respectively. In that case, the tail or the wick of this highest candle will be our bullish rejection block. Usually, we consider 3 consecutive candles near the highs for the purpose of identifying a rejection. Out of these 3 candles, the middle candle has to be the highest of them all. The color of the candles doesn't really matter, but what matters is that the high of the middle candle should be higher than the neighboring candles, and the close of this candle has to be higher than or equal to the close of the preceding and succeeding candles. Now, once all these conditions are filled, we can mark the entire upper wick of this highest candle using a rectangle. This will be our bearish rejection block. We expect the price to swiftly decline lower after the rejection. Such a move would mean that the price has grabbed the liquidity above the highs and then it strongly moved lower. This would also signal that big players were involved in the price move. Keep in mind that the area near the highest wick or the rejection block still contains a lot of orders waiting to be executed. These include a cluster of buy stop loss orders and buy limit orders. So we expect the price to return back to this rejection block to absorb the buy side liquidity. When price comes back to test the rejection block, we can look to take short trade entries. We can make use of the 0%, 50% and 100% Fibonacci retracement levels to place our sell limit orders. We can set our stop loss above the bearish